Hey, welcome to my live stream. It is Wednesday, December 10th. The market is closed. It's been closed for 3 hours. And today we had big news coming out of the Federal Reserve. They lowered the borrowing rate between banks by 25 basis points. And that created a little bit of rally, expecting that, hey, interest rates are going to settle down. It did, in fact, lower rates. Bond prices went up. Rates did go down today, and that makes stocks more attractive because they could have a better rate of return than a lower risk bond. And investors are willing to take higher risk if the rate of return is also higher. So the Fed came in as expected. They reduced the interest rate by 25 basis points in a way that was priced into the market, but the market still reacted positively, especially on the Dow. It went up nicely, about 1%. So that was good. What I observed earlier in the week was rates were actually rising, which didn't make any sense. Why would they be rising if we expected a rate cut? They did. And they probably went down. The rates went down today about as much as they were going up Monday and Tuesday. So that the news that the Fed spoke about was pretty much telegraphed into the market. So no big news there. With regards to the market, we are seeing kind of the market, I'm going to say, grind higher, although the participation was quite broad. The exception of a few stocks like Microsoft did sell off, Uber sold off, Netflix sold off, Meta sold off, Walmart sold off, Costco sold off. Holy smokes. But we had a lot of other sectors and stocks participate, starting from right to left. Healthcare, a lot of green in healthcare. Look at that. J&J up 3.29%. As the interest rate drops, J&J is a low risk, high quality stock, and it's a dividend payer. So I imagine a lot of investors are like, well, if I'm not going to get a good rate from bonds, maybe I'll go to a dividend stock like J&J. So that makes sense why that stock would work. And we had stocks like United Health went up nicely, Pfizer went up nicely, biotech went up. So the health care space did quite well. On energy, same thing. Looks like CBX, Chevron was up 1.97. Excellent. Exxon was 1%. And earlier in the week, I think yesterday or Monday, Exxon was up a lot. Exxon's had a good week. Utilities, not so great. Real estate, a little mixed. Materials, higher. The other thing that came out was economic data saying, or I should say that the data showed that unemployment will not be a big problem. And the inflation will not be a big problem. Those two are good for the economy and good for stocks. So that part is good. And let me say hello to Adam Skidmore. Good to see you back. I am having a good evening. I hope you're having a good evening. Getting ready for tomorrow. Should be an interesting day tomorrow. We have big earnings tomorrow. I'll go over that in a little bit. Tony, the green days are spoiling me. Well, hopefully it just keeps going higher. We catch that Santa Claus rally, end the year, make it a good year, start off on the right foot for 2026. Continuing, what else happened within consumer discretionary? Amazon went up 1.69. Tesla was higher. Apparel, travel services. And I've heard travel is doing quite well. Airlines are booking full flights. There's been the highest number of travelers logged at airports. So the consumer is out there traveling. Home Depot did well. And these with low interest rates, it tends to have people do home equity lines of credit and fix up their home, you know, get that dream kitchen installed and that kind of thing. We'll see how that goes. But consumer discretionary looks terrific. Herdo, man, you are consistently appreciate that. Please let me know what I could analyze on this stream for you, sir. Thank you. Industrials. Now there's GEV, and I'd like to look at it because it was up big. They updated and improved their forecast of what they're going to do going forward, which is phenomenal. It was up 16 point something percent. And I'd like to take a look at GEV. Caterpillar was up. Let's look at Caterpillar. I haven't looked at CAT in a long time, but it was up 3.5%. Consumer staples, not so hot. Walmart gave up a little bit of its big gains. Walmart's been doing well over the last couple of years. Costco has not had a good year. It has not had a good year. It announces earnings tomorrow. The big announcements tomorrow will come from Costco, Broadcom. Those are the two big giant companies. Broadcom's been flourishing, going up in stock price. Can it impress the market and go even higher? Or will it meet expectations, but not have enough magic, enough enthusiasm, enough momentum in those earnings where the market sells it off and says, I want to take my gains. I want to ring the cash register. We will know in about 24 hours. I'll be sure to cover it. I'm going to plan to stream tomorrow night. Tomorrow night is Thursday night football. I stream, watch football in the background, and go over stocks with you guys. So if you'd like to join me tomorrow, it's going to be the same time, 7 p.m. Eastern. I'll stream for a couple hours and then we'll go from there. Man, you guys are just making my evening, guys. Adam Skidmore. Love the fundamentals, but think missing art and product study in some situations. Yahoo's not the most accurate for revenue estimates. Nonetheless, thank you. Thank you. That means a lot. And I hope you're getting a lot of value from the streams. And please let me know what stocks I could review. You guys are awesome. Thank you so much. So we left off on consumer discretionary. Look at the financial space. Banks, pretty hot. Low interest rates. Let's refinance some mortgages. Let's extend some lines of credit out there. Let's let the banks are going to make some money. And other places, what is this little category here? This is insurance. And these are regional banks. They're going to do well because they're going to extend lines of credit to people. All kinds of good stuff is happening within financials. And just to let you guys know, what am I going to create from a content perspective? I think the next best and worst video that I'm going to create is going to be around the best and worst dividend stocks. That's the next one, working on it. And that's going to include like the best quality dividend payers, kind of which ones are good and bad. I think it's a good time, especially if you're an investor that wants income. Well, bonds are not going to pay very much income because interest rates are falling. So it's a time to maybe think about dividend paying stocks. And dividend paying stocks tend to be lower risk. So good idea if you're trying to de-risk your portfolio. If you're a little older, maybe you're younger and have made a lot of money, worked hard for your money, and want to make sure you preserve it. And then after that, I'm probably going to do a best and worst in industrials, kind of highlighting some of these traditionally great businesses, kind of spotlight those. Then after that, we're going to go to the banks, best and worst banks. And I think it's a good idea because they should do well in this low interest rate environment. They get to refinance loans. They get to give out lines of credit and make good money. Communication services had a mixed day. There's some pretty good red spots here. Netflix is still struggling. Man, we should look at Netflix. Netflix has been falling, and it's kind of a stock that is not all that desirable to me right now because they're in the middle of an acquisition. I don't know if the acquisition is going to go through, but they had come to an informal agreement of some sort with Warner Brothers. Netflix was chosen as, okay, Warner Brothers has chosen Netflix as the partner they would like to merge with. And Paramount said, no, not so fast. And they launched a hostile takeover of Warner Brothers. So I think that's going to get contentious, and I don't know. I don't know what's going to happen. I already believed that Netflix was priced too high before all this merger acquisition stuff happened. So at this point, I'm like, I, I wouldn't be touching it. It looks like T-Mobile had a bad day. AppLovin gave up some of the big gains it's had recently. I took the opportunity to buy some AppLovin today. Took the opportunity to buy some Uber. So I could add shares to those two holdings. Looks like the semiconductor space, these spaces look good and green. Palantir had a good day. Micron had a good day. Qualcomm had a really nice day. And we're setting up for tomorrow. I think tomorrow Broadcom will be the biggest market cap that will announce earnings, and we'll see what happens. All right. So again, especially the guys who gave me the super chats, please let me know what's something you'd like me to talk about, some stocks you want me to review. Please put them in the chat and we'll go through it. PLAB had a good day. PLAB, what is PLAB? I'm not sure what that is. I'd like to know. PLAB, Photronics, I think they announced, yeah. So together with the subs, they manufacture photomask products, services. Okay, so they're in the circuit boards and so forth. Okay, cool. Yeah, they had to say they had a good day is an understatement. Awesome day, 45%. What the heck? What a day. Is this a small cap? Yeah, small cap. Incredible. They certainly did have a good day. Herdo, do you have any thoughts on SpaceX going public? I mean, SpaceX is going to be a very large IPO, and I don't really invest in IPOs. They tend to lose money the first couple of years. So let's ask Gemini what the valuation. See if Gemini has a sense of what the valuation is. So SpaceX most recent private market valuation is approximately 800 billion. Wow. So it could IPO and get up to a value of 1.5 trillion. Wow. Incredible. Last time I thought it was like a $300 billion valuation. Yeah. So it looks like they're trying to IPO in mid 2026. Incredible. If they get priced at 1.5 trillion, that will be the biggest IPO ever. That's huge. SpaceX is the leader in launching satellites and stuff into space. Undeniably, they're the leader, and Rocket Labs is, I think, in second place. Both companies get a lot of attention, understandably. That keep me from being excited or an investor of SpaceX. First, I don't like IPOs. They tend to lose money, and it could be a high quality stock. It could be a low quality stock. They just tend to lose money at the very beginning. And you can look at Palantir, you can look at Robinhood, you can look at um, Reddit. These are really good stocks, but early on, they just they lose money early, and it's my plan to just wait. Let's go with Robinhood. So Robinhood, they IPO'd. They IPO'd way back here, but I think this makes the point. So they IPO'd up here. They sold off harshly, right? And then they came back and roared higher. Okay. Well, I just kind of give it a year. Robinhood, I didn't buy Robinhood back here. I bought it back here. So I'm doing great. Awesome. Let's look at Reddit. Reddit had a little bit of a different path, but similar. It kind of got out of the gate, not too fast, and then it went up higher, and then it came down. That's when I bought. It was roughly about a year after it IPO'd. And I was able to invest into this quality company. And from there, it's gone higher. Okay, perfect. And then I'll show one more IPO stock. I think we went Palantir. Let's go over Palantir. So Palantir has been a super winner. They IPO'd back here, ran up the stock. The stock settled down about 80%. Whew. Man, imagine that. And then whoever bought here, right, you made a killing. Incredible. So over and over again, IPOs, I think SpaceX definitely is the leader. I think we're going to continue to launch things into space. But it's just something I stay away from. So that's the first reason I stay away from IPOs. The second thing I don't like is if you look at, especially Rocket Labs, is already publicly traded. So let's take a look at Rocket Labs. I'll show you what I don't like about aerospace companies. So when we look at like what great looks like, you could say, hey, let's look at Nvidia. And you see that you have high revenue growth and you have exceptional profitability and free cash flow. So Nvidia is growing really fast and they make a lot of profit, 53% profit margin, 41% free cash flow yield. Those are phenomenal numbers. This is what great looks like. Well, we go over to Rocket Lab, which is a great company. I'm a fan of Rocket Lab. I think they're cool and they are growing. Check that box, growing. Perfect. Let's take a look at the other pieces. Gross profit, 31%. Nvidia is at 75. Okay. Profit, 35% loss. And these guys are not like brand new. They've been launching stuff into space. They have a pretty good backlog. So you're losing a lot of money in operating this business. Now, at some point, will they make money? I think so. But they have a ceiling. You would think they're not going to make more than 30%. And that's if they have like almost no cost, which is impossible because if you're going to run a rocket company, just about everybody has an engineering degree or a physics degree or some kind of science degree. So they want to be compensated fairly. And that type of cost structure keeps an aerospace company from being just incredibly valuable in the form of high free cash flows and high profits. So that's the second thing I don't like. SpaceX is not going to avoid this. And it's the same thing that you look at in Tesla. Tesla doesn't make a lot of money. And people will continue to say, some people not, like myself. I consider Tesla a car company. A lot of people say, no, it's not a car company. You have it wrong. It's a technology company. I'm like, okay, I'll give you that. They're not growing. Okay. We could all agree on that. These are just facts. These are just numbers that Tesla themselves produced. And let's look at their profitability. The gross margins are 17%. the maximum they can make in net profit if they don't pay anybody any money, if they basically operate with no operating expenses, which is impossible, 17%. So their profit margin is 5%. Nvidia was at 53, Tesla's at 5. So call them whatever you can call them a technology stock, you can call them a magic stock, you can call them whatever you want. But these fundamentals are nowhere near what great looks like. It's quite terrible. So back to aerospace, these numbers are what I don't like. So I don't like IPOs and I don't like the profitability and the fundamentals of aerospace. I don't want to get caught up in how cool and exciting aerospace is because it is super cool and exciting. You know, I think very highly of astronauts. I think it's super cool. But what I think is my job with my portfolio is advancing my portfolio every year, outperforming the market, and I'm not going to get caught up in a big story there. So that's how I feel about it, Herdo. And if somebody else is out there that has a better sense on like aerospace, because Rocket Lab's been a winner, absolutely, and it's had a nice little rally lately, so it's kind of gone up. It had a nice correction here, but it's beginning to rally again. Good luck to you. You know, I don't get to invest in aerospace. I just gave my reasons for it. And I don't want to invest in IPOs. And I think I've shared those reasons too. So yeah, it is super cool. Astronauts are cool. I watch documentaries on the Apollo missions. I think it's incredible. The engineering and the science is phenomenal. You have to establish escape velocity to leave the atmosphere and the gravitational pull of Earth. Love it. Love it. But I also love making 700% on my Robinhood stock over the course of 2 years. I love that. I love making on Astera Labs. Um, I doubled my money in 3 months. I love that. That's my job. I'm not an astronaut. I'm not a space traveler. I'm not a engineer of that sort. My job's to maximize my portfolio. Good question. That's going to be exciting. The market's that's going to be like one of the hottest stories of the year. Tony, do you think Google will sell? Do you think so? What TPU? So are those like the semiconductors that they're using for data centers? I think that's what you're referring to. Um, and I don't know. I think they somewhat sell their semiconductors in their data center. So you're kind of never transferring title of compute. But when somebody goes and says, "Hey, Google, I want to run my workload inside of Google Cloud," they do that. And you can pick their semiconductor. It has a cost to it, and you're basically renting it out. So it's a different form of selling it. You're just selling the capacity. Anthony, yeah, ASTS was up. And again, we're going to see, at some point you have to think there has to be some money made, right? Because even these businesses, they don't do it for funsies to kind of say, hey, we sent something into space. This is an $18 million revenue company trailing 12 months. And they lost. Oh my gosh. They lost a lot of money. So they lost $303 million. Oh my God. So 18 million in revenue, over $300 million in losses. Wow. Talk about being really so they how rockets burn so much fuel on takeoff. These companies are burning so much cash, and their stock's going higher, right? Yeah, look at that. Incredible. But for a while, investors were looking at those fundamentals going, I don't know. Looks kind of crazy. But I think the whole SpaceX IPO is probably making everybody else look more valuable. And I can understand that. And investors got excited. And this stock was trading way down here at like $2 a share, up here at 79. We'll see where that goes. Not my lane. My lane is I want to see fundamentals. I want to have a very solid understanding of their forecast, be able to value that forecast, and then set my path on that stock. So that's what's going on there. Thanks, Herdo. Really appreciate you. Benton, doing the the morning stream and the evening stream. Yeah, it's awesome to double. And I also took a material stock and made like 50% and got out. That was a good pick in 2025. Can we look at SOBO? Definitely. SOBO. I put it on the list and we will cover it. Oh, let's not look at. So, okay. Not looking at it. No problem. Scratch it. Okay. So, I am open to taking requests. Let me know what you guys want to take a look at, and we'll go from there. In 1 second, everybody. All right. Sorry about that. Okay, so let's get into Uber. Uber was down a lot today, and I want to try to get a handle on what's going on over at Uber. Sold off by 5.51%. And what was going on? Oracle teams with Shopify to offer merchants 1 hour delivery. Interesting. Okay, that couldn't have caused a sell off. So is Bill Ackman a holder of Uber? Let me confirm that. Bill Ackman. There it is. So Ackman, he really concentrates his positions. It looks like he's got $3 billion invested in Uber. Okay, so the answer is yes to that question. So what made Uber sell off so much? It sold off 5.5%. The market was generally higher. I'm not seeing the story. I'm not seeing why Uber sold off. Let me ask Gemini. Maybe Gemini knows. All right, Gemini. Uber sold off today, December 10th, primarily due to a price target cut by Morgan Stanley. In the news, the company is scaling back incentives for electric vehicle drivers amidst rising regulatory pressure in Europe. Uber down 5.5%. I don't imagine that just a price cut is going to drive that type of sell-off. Interesting. What's it doing in after hours? It's up a tiny bit, no big deal. And I mean, I bought shares of Uber. I saw it as an opportunity to jump in and grab some shares because I think the value of Uber is much higher. I'll show you the valuation, then we'll go look at the fundamentals. I think Uber just is a really good business. They're growing really well, growing at 20%. They can grow without deploying a whole lot of capital because drivers provide their own cars. And it looks like if they start doing 1 hour delivery for merchants that are on Shopify, those drivers can earn more money and they can use their own vehicles to do those deliveries. So overall, low capital intensive business, which enables them to keep a lot of that cash, and their cash forecast is really, really valuable, driving up the valuation. And I believe that based on the value of their cash flows, the value of their cash flows is 69% higher than the current stock price. And the value of their profits, using a PE of 30, I think they deserve a 30, growing 20%, having momentum, that their stock price is discounted by 33%. Looking at the fundamentals, it has become a pretty good sized business, 174 billion. It's still performing well for the 1 year, even though we had that big drop. And if you bought at the right times, you're sitting on really good gains, going from $21 a share up to 84. So that's 400% rate of appreciation if you bought in 2022. So the forecast for Uber, we have 32 analysts covering it. They think it's discounted by about 29%. And the forecast says they're going to grow at 15, close to 16%, 14.5, and then 11. And their profits are supposed to take a hit here in 2026, but the PE ratio is still going to be very, very investable, really high. And this one here is very investable, 15.73, 23, 18, 14. And we have a lot of analysts covering it. So this is an opportunity for me. I think analysts think it's a good investment. It is a good profitable business. When you look at the quarterly, growing at 20%, if they can continue to outperform on that revenue line, I can only see the stock going higher. They produce really good free cash flow. Remember the comment I made that they don't have to buy any cars to grow. The drivers provide the cars. So the flexibility of not having to put a lot of cash and capital into the business to grow it, that's a huge advantage in this business model. And although their gross margins are 34%, they get to keep a majority of that in the form of profit. 33% profits, very good. 17% free cash flow margin, excellent. So these fundamentals I really like, and I like the growth. I like the cash flow. So overall, I think Uber, one of my biggest positions, the fifth biggest position, and I took the opportunity to buy more shares. Sometimes the market will do that. And it has sold off Uber quite drastically. The stock market has. Looks like it's going through another sell-off. And I think Uber is going to be fine in 2026. So that's a surprise that Uber sold off so much, but it happened. Looks like Anderson is on. Good to see you. Hope you're doing well. On Uber, be aware that their free cash flow has one-time tax benefit effects. So now that they are creating profit, they would see a decrement to free cash flow. Potentially that could be the case. But they've been profitable for quite a while. Let's see here. So they were profitable last year and they paid out tax and they still had the free cash flow. So let's take a look. So 2024, they grew 18%. They had good profits and they paid income taxes. They paid them in 2021 as well. So this impacted most definitely, their cash, but they still had free cash flow grow to 6.9 billion. So I get your point. I agree with your point, but the cash flow is still good after tax because they showed it in 2024. And if we look at the trailing 12 months, let's see how much they've paid. Income tax Okay. Income tax 0.3 billion. So there's the taxes they paid, and they still drove very good free cash flow. See how it's expanding. So very good point to make. I appreciate it. Makes me think and make sure that I'm not missing something. But I think they're going to be okay, even though they're going to pay taxes on profits. Thanks for bringing that up. And you are also a big Uber investor. Good luck to both of us. Okay, I'm gonna keep an eye on that. Thanks for bringing that up. I appreciate it. I'll keep an eye on how their free cash flow is going to be affected by the change in their taxes. Another stock that got hit pretty hard today was Maple Bear, and their businesses. We know it as Instacart, the delivery company for groceries. And these guys, for the 1 year, there's been moments when this stock's just killing it, right? But the market's just not completely convinced. And today, it showed signs that it's afraid of the stock. The news that I heard is that Instacart does some pricing when you go on and you load your basket with groceries. It does pricing, and they're being accused that there is some price discrimination going on. I'm not sure what that means. I'm not sure if it's just a story that has the right buzzwords for the media to get all over it, but that's what kind of created some concerns, and the stock sold off. Now, this stock has, every time there's a story, this stock gets hit, and it hasn't flourished because another story that hit it before was, oh, Amazon's going to go after them. Amazon's going to do grocery delivery. So here we go. Instacart, you're going to be under threat. And the fundamentals of the business, the revenue growth actually improved like a quarter after that story. So I think that story was kind of, you know, proven to be incorrect, or it was just a theory that was unproven. Now, with this story, the stock gets hit again. So I'm beginning to think maybe this stock just is a magnet to negative stories. And at what point will investors become deaf to these stories, because these stories are just not factual? Let's take a look at the fundamentals. So this is, market cap's tiny compared to Uber. Uber was close to 200 billion. This is 11.4 billion, revenue of 3.6 billion, and forward PE for the year that's beginning in a couple weeks, 20.35 PE. That's not bad. Analysts do think that there is a price discount available. When we look at their forecast, analysts, 24 of them think there's a 22% discount. And it's expected that these guys were, in this year, they're growing at 12.4, and they're going to grow at 9.3, 9, and then come down this year. I'm not sure I agree with that, but for the next 2 years, the growth is going to be good. It's not going to be great, but it's going to be good. And the profitability is going to expand nicely. And their PE is going to come down. I don't think that's going to be the case. I think this stock will go higher. And a lot of analysts are putting their research behind that. Now, this business does have some desirable attributes to it when we look at the stock fundamentally. Now, it's a smaller business, so growing 10% is not an A+ grade. It's a passing grade. It's like a B. You know, you passed, you're growing, good job. But at your size, you should be growing at 30 to 50% to really get that A+ kind of grade. Where they do look good is down here. Gross margins, they have very good gross margins because they don't really own the groceries or the inventory for groceries. They're in essence providing the service that people would use. Then they partner with the grocery stores. So Instacart, does not need to manage the inventory, manage perishables and all that good stuff. They don't have to deal with the low margin business that Kroger and other grocery retailers have to deal with. They're just earning the fees of taking the order from the consumer. Somebody picks that they need, want, and they deliver them to somebody's home. So that makes them an attractive company because the gross margins are really high. They do have a profitability. I think they could do better than that. I think as they get bigger, they will be better at turning a lot of that gross profit into profit margin because they'll become bigger, more efficient, and drive that profitability. The free cash flow margin looks good and can get better because they're not having, it's like Uber. They're not having to buy cars and infrastructure. The driver or the delivery people will use their own car. They don't have to open any stores because Kroger and everybody else that uses Instacart, they also deliver for Costco. Costco, Kroger, they're the ones that are building the stores, holding the inventory, and then having Instacart deliver. So I like the business model a lot, which is why I own the stock. I like these fundamentals, but the market does just takes the opportunity to sell this stock off quite often. It's been a little bit of a test of my patience, so to speak, because I'm not really, this has been an underperformer in my portfolio. But I think I'm going to hang in there. I think it's doing okay. They announced their earnings on November 10th. So that was a month ago. So we got 2 months before we get some fresh data. It'll be for the full year 2025. And for now, I'm not going to buy any shares. I'm just going to hang on. I didn't buy any shares today. I just want to hold my position in Maple Bear and see how the earnings come out in 2 months. Maybe give it another 6 months to see how the market treats it. But at a certain point, it's not a major position. It's probably like 1% of my portfolio. While Uber is a big position, it's more like a 5% position of my portfolio. Maybe in 6 months, if the situation doesn't improve, where the market begins to price Maple Bear closer to its intrinsic value, I'll probably cut bait and just concentrate this capital into other stocks like Uber. Looking at the valuation for Instacart, or I should say Maple Bear, 56%. So it's a very discounted stock. Now, this is a kind of a small business. I could see it being acquired, by the way, or merging. I mean, they could merge with like Lyft or another company that's kind of in a similar space. That would be a good idea. Make themselves bigger, kind of be able to have a bigger, more powerful network effect. And that could create a little more of a moat, the ability to retain its customer base and even grow its customer base by having a greater population of people that do business with them, either for mobility or grocery delivery. And if they're already doing product delivery, by the way, they're doing grocery delivery, which is harder than delivering, let's say, a product. Somebody has to buy something from Best Buy and they're like, hey, get me new printer ink for my printer. And they run over to Best Buy, pick that up and deliver it to your house, and they charge their fee. That's a very convenient way of getting that product. They can do that. They're already doing that. So they can expand that as well. So that is Maple Bear Instacart under pressure today. And we'll see if the market stops abusing Maple Bear. All right. So it looks like I'm going to keep rolling here. Again, if there's some stocks you guys want me to talk about, please put them in the chat. Be happy to do so. Thanks again for the super chats, guys. You guys made my night. I appreciate it. Herdo and Adam Skidmore, you are awesome. Thank you so much. All right. So Synopsys announced after the market closed, and the stock is up 2% in after hours. Synopsys provides electronic design automation software products used to design and test integrated circuits. It operates in two segments: design automation, design IP. So semiconductor companies that want to design new semiconductors and microprocessors, they work with like Synopsys software so they can develop that product, test it, and make sure it works. Now, the performance of the stock year to date is not good. Once it goes up 2%, you'll be back to even. Over the 1 year, not good. Over the 5 year, it looked good for a while. As we saw the data center spend really crank up and Nvidia and everybody crank up, this stock really performed. It rose from $250 a share up to $621. But since then, it's been kind of rough. It peaked out in mid-2024, and since then, it's been rough. At times, it looked like this thing was really going to work, but it gave up all those gains. And part of the problem, in my opinion, with this stock is it's a $90 billion market cap. And let's look at their growth. Quarterly, 14% growth. And again, this is a good growth rate. It's a smaller company within this space. So it's a good growth rate, but it's like you got a B on your exam. It's not an A plus. A plus, you had 98, 99, 100% of the answers correct. No. You got a passing grade, 14% is good. When you look at the trailing 12 months, 8%. Again, passing grade, maybe a B minus, but it's still a B. And when we look at the amount of free cash flow generated, 1.3 billion. The yield, 20%. Profit margin looks good. Very high gross margin. Software companies tend to be like this. So looking at their trailing 12 months, and I looked at their forward, they guided for 2026, and they guided that they were going to do 1.9 billion in free cash flow. If I take that cash flow and multiply it times 20, I would get basically 1.9 times 20 would get me to 38 billion. If I multiplied it times 30, it would get me to 57 billion. So 57 billion being the most I could imagine myself being willing to pay for this business minus debt. And looking at the debt level that they have a little bit of debt. They have about $12.5 billion of debt. So I would decrement that from the 57 billion. So it'd get it down to 45 billion would be the maximum market cap that I would see that this stock is worth. They're way up at 90. So the free cash flow is nowhere near where it needs to be. Just remind you, this is what great looks like. Okay. Nvidia, same industry, but different companies, right? They're kind of in the same ecosystem. Synopsys is doing something different. But kind of using the same rationale. You have a company that's growing really fast. The free cash flow, 77 billion. Now, at this accelerated cash flow, I'm willing to pay 40, 50 times its cash flow rate. If I go 50 times, I'm up to nearly 4 trillion plus cash. And these guys are sitting on 50 billion of cash. So I'm clearly at 4 trillion in market cap value, and they are above that, but not too far off. They're about 10% high. So we're a lot closer. This is what great looks like. You can buy great for a better valuation. Why would I buy not great for a very expensive price? So that's how I like to value companies is let's value them based on how much money they're going to make and how much cash flow they're going to drive. And then making decisions based on how good or bad they are along those metrics. And Synopsys just doesn't add up. And I think that's why investors found themselves really mixed on the stock. Hey, it went up because of the story. Data center semiconductor is booming. But once investors would look at the fundamentals, they're like, I got to get out. And they got out. Pressure on the stock, this thing sells off hard and fast. So Synopsys is not something I would want to buy. It's not even a stock that I want to watch because it's too far off. I don't want to waste my time looking at a company like this. But they're having a good night. Congratulations to the Synopsys team. All right. So the other company looks like Mohammed. Very good to see you. Thanks for joining. So let's take a look at GEV. They had a really good day. So GE Vernova, General Electric split into three parts. These guys, GE Vernova, an energy company, engages in the provision of various products and services that generate, transfer, orchestrate, convert, store electricity in the United States, Asia, the Americas, the Middle East, and Africa. The company operates three segments: power, wind, and electrification. All right, let's take a look at their website. So this is GE Vernova. So the news is that I believe this report is what caused the big rise. So a stronger financial trajectory with substantially higher returns expected beyond 2028. Okay. And it's no surprise we need more power. Data centers and our lifestyles just require more power. Like I got an EV this year, added it to kind of the cars that we own. Now I'm charging up an EV. Well, that's increase in power demand from my house. I did put solar panels on our home 3 years ago, so I did kind of go kind of net neutral for a while. But I'm expecting that now with an EV, I'm going to be drawing more power from the public utility. So these guys now anticipate $52 billion revenue. Okay. And let's take a look at how they're growing. So this is going to be 52 billion by 2028. So let me write that down. 52 billion by 2028, and then we'll see what kind of growth rate that's going to be in the future. So the story around electricity and utilities, I mean, it's real. Just utilities have been just the fundamentals that I've never liked. It's always kind of a tough business for me to warm up to. And this stock's really up 120% and 528% with the whole story moving the stock higher. So the market cap, 196 billion. PE is pretty high at 66. And analysts do think it's a little expensive. When we look at the growth rate, where is the growth? Why is this stock going up like a bottle rocket? Where show me the growth, man. This is the quarterly. Okay. So the trailing 12 months, 9.44%. Where's the growth? Now, they're supposed to get to 52 billion 2028. So I'll get to that later. Okay, so 9.44% it's a pretty big business. So I got to give them credit. This is good growth, but when your stock is up 500% over the last 3-4 years, I'm expecting to see a number like Nvidia's, 60% growth, 100% growth. 9.44 is not that exciting. But let's carry on. So trailing 12 months. Now we're going to look at the overall cash flow and profitability. All right. So gross margins 19.69. Again, that's the ceiling. 19.69. They can't make 50% profit margins because 19.69 is the gross margin. Okay. Now you got to have brings it down to 5.4, profit margin 4.5. So the market's doing backflips to buy GEV, and they make 4.5% gross margins. Profit margin, excuse me. And they have a 6.57% free cash flow yield. That is terrible. Let's remind ourselves what great looks like. This is what great looks like. You have high growth rate. This is exciting. They're big. They're growing fast. And when we get down to the profitability, high gross margins, high profit margin, high free cash flow margin. That's what great looks like. And these guys are up. Nvidia deserves it. Why are these guys up so much? There's not a lot of money to be made in this business. I think it's a good business. There's demand for it, but it's just not a very lucrative business. All right. Let's look at the forecast. 25 analysts are covering this stock. And this year, we are, and this is funny, they had a big press release saying, we're going to hit 52 billion in 2028. Well, analysts already had that in their forecast. So there's really no big news. There's no news. They're just citing what analysts were already saying. They're going to be above 52 billion in 2028. All right, so moving on. So what is reality is they're supposed to start growing a little faster from 7.8 to 11 to 14, 12.5, 10.7. This is good growth rate. Okay, this is like a solid B on an exam. Not an A plus. A plus is Nvidia. A plus is Palantir. A plus is high growth, fast growth. Profitability, they're supposed to expand their profits. That is good. Very good expansion of profit. And they're going to bring down their PE ratio as they should. This PE ratio on a company like this with low margins should be 20 or less. So eventually it should get to 20 and then eventually get to a lesser amount. If they have a hiccup, if they're like, oops, all that infrastructure spend, like Meta had to pause it. A lot of businesses paused and they're not going to buy as much stuff from us. Man, this is going to be a falling knife at some point. But for now, the market loves this stock. It thinks, man, we're just going to see this stock go up. I agree that they're going to grow, but they're not going to make a lot of money. The valuation on this, I don't know that I have a valuation. I can't even get close to it because it doesn't make enough money. Here's GEV. I mean, look at this valuation. I'm so far away from it. It's just ridiculous on it. And here's the analogy I like to say about, the big build out in data centers and the amount of money that's being invested. You have participants like GEV, you have data center operators like Microsoft Azure, and you have Nvidia that's selling that really sought after high performance compute GPU. So you have all these different players in the same ecosystem. And you got to think about the ecosystem kind of like a football team, American football, where you have quarterbacks, linemen, linebackers, and so forth. Now, on the team, you have an organization and you have the players. You have a quarterback that makes $50 million a year. And if you have a good quarterback, that's what they're worth. You have other people, like you might have a coach, you might have an equipment manager, and they're part of the team. They're important. They don't make as much money. Equipment manager maybe makes 100 grand or so, I would think. And maybe coaches, but they don't make 50 million like the quarterback. Now, what I would say is if you're going to give me a choice, Hey, which role would you like to have on the team? Well, I'd like to be the quarterback, thank you, because the pay is great. I know it's an intense job. It's a sought after job, but I'd rather be the quarterback and make 50 million. Now, when we look at businesses, I want to Nvidia is kind of like the quarterback. They make lots of money. And GEV is on the team. They win the Super Bowl, they get a Super Bowl ring. But you're paying a really high PE. You're buying into fundamentals that are not all that desirable. They don't get paid a lot of money. Okay. So, yeah, you're on the team, but you're not making a lot of money. Congratulations. You get a Super Bowl ring. You get to participate in the AI build out of data centers and the whole electrification that's going to be required. So, it's important to just know what we're investing in. Are we investing in a very fruitful, lucrative, profitable business or not? If I'm okay investing in businesses that maybe have lower margins, I just want it to be priced right. I want to buy it right. I don't want to buy into something because it's a market that just is buying everything that is involved with the data center, and the story of we're going to need power continues to linger. Yeah, we're going to need power. I agree. But power companies are not that valuable. You look at utility companies, they have very low valuations. So GEV, I'll continue to be on the outside, and we'll see where it goes. You see that it's only been IPOing. It IPO'd in 2024. It was the break of General Electric. General Electric was a company, and then it had its problems. It broke itself up into three pieces, and this is one of the pieces. So we don't have a lot of history. So that is GEV. All right. So good to see you from Portugal. And if you want me to look at Aries, glad to buy a $5 super chat or maybe a €5 super chat, and I could take a look at it. Thanks for joining. It's great to have you. All right. So let's take a look at Caterpillar, since we just looked at an industrial stock. What is Caterpillar all about? And Caterpillar did kind of catch a nice little bid because it also has power generating capacity. So look at that, from early 2025, after the whole tariff scare was over, this stock really moved higher. It pretty much more than doubled in value. And over the 1 year, up 54%. Okay. Market cap 288. P ratio is 29.9. See where the growth is at. So they did have a good quarter, and maybe that is part of the reason why the stock rallied higher so much. But look what's behind this quarter. Contraction, 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 contraction. So they contracted for 1, 2, 3, 4, 5, 6 quarters in a row. And that is not a boom cycle. No, it's not. And then you finally grew a little bit. Okay. And your compare is against a quarter that had contracted before. The reason I point that out is if you compare it over here to Q4 of 2023, you only grew a little bit. Okay. So you're being compared against an easy compare quarter. Trailing 12 months actually shows a contraction over the trailing 12 months. And we look at cash flow has been decreasing. Okay, that's not good. We want to see this increasing. We don't want to see it decreasing. Gross margin, the ceiling is 30%. Profit margin, they do a good job of holding a lot of that money and seeing it down to a profit margin. This is a B grade. This is good. It looks like it's a well-operated business. They have good discipline. Free cash flow margin is also good, but it's not great. So the free cash flow, 7.5 billion, have a strong reputation. So they'd probably be worth 150 billion minus debt, because I'm multiplying that number times 20. And when I decrement the debt, I think they have a little bit of debt. Yeah, they have $35 billion of debt. So These guys would be like $115 billion market cap business, and they're way up at 287. So I'll let somebody else own Caterpillar. I think it's going to end poorly because not too long ago, this stock was $164. What's it doing at 615 after it's gone on this kind of a setback year, and the trailing 12 months shows contractions? What's it doing? Price so high. It's the story. Hey, we're going to need Caterpillar. We're going to need it for a bunch of stuff. That's fine, but the numbers tell me something very different. They do some of their equipment is to generate power. I don't think we're having a boom cycle around infrastructure where we're doing construction and so forth. Lower interest rates should help, but it's not going to be like overnight Caterpillar is going to sell a bunch of equipment. I don't think so. So this one here seems to be really priced too high. So Caterpillar is catching a lot of investors, seeing the stock price go higher, but I think it's going to be a little bit of a risky situation, and I am going to stay out of it. All right, let's go to the movies. Let's go to Netflix. So Netflix, it hasn't had a good month, down 16%. It was having a good year, and then all of a sudden, from June, and this is before the whole merger thing, right? It started to sell off. Now you can cite me on the videos that I created. I've been creating videos on Netflix. I was a Netflix stockholder, made money on Netflix. I bought it at the right time. When we buy stocks is really important. It's might be the most important decision we make on a stock. And I bought at the right time. I bought here. So the stock went higher, and I was able to sell it at a good gain, moved on, took the profits. And then I, with envy, saw the stock go higher. But I thought that, hey, you know what? Netflix is priced too high. I got to a point where it's like, I did really well in a short period of time, excellent rate of return. And the company really is worth $79 a share. That's what it was worth to me based on cash flows. But the stock is trading above that. And for a while was trading way above that stock. Once I was like, you know what? Stock's gotten a little too pricey. I'm taking my gain. I'm going to put it in the bank. I'm going to invest in other things that are going to go higher. And it looks like that decision, although it was a little early, it's always hard to time it perfectly, ended up being like, okay, well, I ended up not losing much. And my capital didn't do this like U-turn, go up and down. And I've been deploying that capital elsewhere. So this stock here has been a disruption, I'm sure, to a lot of portfolios. And who owns this stock? There's a lot of well-known investors that are in Netflix. And if you go back in the last couple months, they were like, buy. Man, Netflix is awesome. And now they're probably like, oops, don't buy. And one of the best investors that I know of, Chase Coleman, this guy's the real deal. Chase Coleman is a really good investor. His performance this year is really good. And he owns a lot of great stocks. He owns a lot of stocks. And he owns Netflix. So this guy's the real deal. He bought into Netflix. Goes to show what we do is difficult. Even the best investors out there will get themselves in a stock that doesn't perform well. So Netflix is under pressure. I thought it was too expensive. Now we have this whole mess of they're trying to acquire Warner Brothers. They're going to get into a massive argument with Paramount, and it's probably going to get ugly, and we'll see who wins in the end. But I'm glad I'm not in the stock because the last, the stock's gone from 133 to 92, and it keeps falling. Not fun. I'm sure investors are just getting out every single day. A lot of investors are getting out. So it's going to be an ugly, ugly situation. It's already an ugly situation for Netflix, at least from a stock price for, being a stockholder. It's been a rough ride. We'll see when it ends. All right. So we are cruising. We covered a lot of ground. We've got 6 stocks on the books. What would you guys like to talk about next? Let me know. While you think about it, let me tell you about becoming a member of this channel. I have this channel on YouTube, and I take quite a bit of time each week to create videos. And I predominantly create videos for the advanced member. And this is like today, as an example, I did a video on the earnings that were reported by Adobe, and I published it out to advanced members. I updated my research, and it arrives to them first. And if you're a super member or a platinum member, you get everything in the levels below that more expensive level. So super investors could see it, platinum investors could see it. And they could see my research that was pretty much real time. Create the research, I put it out there, and then investors can view it. So this is a really nice program here. This is a really nice program as well. This is fairly popular with a good number of members. And this one, the difference being, I also share my trades a couple of times a week. I share a video on what stocks have the highest level of conviction, put that out to super investors. And I offer a 30-minute phone call each month with super investors. So this has been a good program. And then for investors maybe that are needing more research, platinum, you give me 3 stocks. I go all the way. I research those stocks. You get a 30-minute call each day. You get real-time access to my research and valuations. You're basically looking over my shoulder if you're a platinum investor. So depending on the level of access that you would like, and on streams, if you just want to come on streams and put a stock down that you'd like me to look at, become a value investor and you get that perk. So take a look. It's on the homepage of my channel, and I appreciate you considering it. So tomorrow, I guess this would be a good transition here. We're going to see Costco announce. That's a really popular stock. Broadcom. This is going to be after the market closes. Lululemon, Restoration Hardware, and a bunch of other stocks, but these are going to be the big hitters. Broadcom, Costco. And I'll be sure to stream tomorrow so we can talk about it, and we'll cover that. All right, so looking at the futures market, it looks like the S&P sold off a little bit, NASDAQ sold off a little bit. The Dow is holding it together. Gold is going up in value, and crude oil is advancing. Crypto, the Bitcoin is pretty much flat. All right, I think it's time. I think we have Japan markets opened a little higher. I'm not sure if the Shanghai is open yet. No, this is yesterday's close. No, this is today's close, December 11th. So this is where Shanghai, China is trading today. All right. And back to the futures. Now we're right across the board. So hopefully it picks up from there. Let's see what Polymarket has to say about those earnings that are coming up. I don't know if you guys glance at Polymarket. This is the prediction market site. I believe these guys are the leaders. I'm wearing a Kalshi hat, if you noticed it. They're the competitor to Polymarket. And these guys, this is pretty much the odds of Broadcom beating the earnings, 93%, Costco 95, Lululemon 94, Restoration Hardware. I think people are feeling nervous about it. Only 40% of those that are willing to put a bet down or buy a contract believe that Restoration Hardware is going to beat earnings. So that's not a vote of confidence. Let's see if we can find Kalshi and see if Kalshi has the same information or maybe even better information. Let's take a look. So sports, financials. So Netflix price increase, but I'm not seeing much information on earnings. See if I search it. Yeah, they don't have any earnings calls, so I guess Polymarket's going to be where we go to see what bettors are thinking. So, all right. All right. So, just a reminder, if you'd like me to look at a stock and you're a member, pop it in the chat. Glad to do that. If you're not a member, buy a $5 super chat and I can cover your stock. Let's keep rolling. Let's start working on some stocks that I wanted to get my head around. And let's go into some of the best dividend paying stocks. So we're going to go into Exxon, J&J, Bank of America, United Healthcare, Morgan Stanley, Merck. And this is according to stock analysis. So, and this list shows top rated dividend stocks according to stock analysis. Each stock on the list has an average buy or strong buy rating from at least 10 analysts. Each stock also has a dividend yield of at least 2%, a payout ratio of under 60%. So that's pretty good. That's pretty good quality because you have a chance of seeing your stock appreciate and it's going to pay you income. So that's not a bad situation. So T-Mobile, Novo, Citigroup, AT&T, Accenture, and Verizon, Gilead, Union Pacific. And I think that's enough. I think that's enough to keep us busy. So Exxon's a oil company, a energy company, and they pay a nice dividend, 3.45%. The 1 year is up 588. Now you would be underperforming the S&P because the S&P is up the S&P is up 17%. So Exxon, you'd be underperforming the S&P. Now, a lot of analysts think it could go higher by 8.75. So it's not a giant discount. Oil prices would need to go up in order for Exxon to become very profitable. Okay. So that's where the price of the stock has been. Looking at their financials, they grew a little bit last year, the last quarter. They've been contracting because oil prices have been down, but oil prices have been going up in the month of December, and that's helping Exxon. So that's good. We look at their forecast, 18 analysts cover it, and they do expect that they're going to grow a little bit in 2026, 2027. They're going to be mid-teens PE ratio. So you get paid that dividend. And if oil rallies, you're going to love it because your stocks are going to go up very fast if oil rallies. Now, I think Exxon, I have a valuation on them. Let me open that up. I think it's 29% discounted. This is how I get there. Their cash flows are excellent. $32 billion of free cash. Now I go with a higher discount rate because oil, it could go up, down, it could surprise us. So Exxon is a discounted stock. If oil prices rally, winds go down, it's going to struggle. And they had been going down for the year of 2025. So this one's kind of a safe bet for an investor that wants a safer bet, an income and the opportunity to see a stock rise. So that is Exxon, one of the stocks that Stock Analysis said is one of the better ideas for some of the best dividend stocks out there. I won't disagree with it. It's not a perfect recommendation because you're dependent on oil. And if I'm going to go into a low risk investment, I'd like it to be pretty much like, hey, chances are for the next 3 years, it's going to be a good stock, like healthcare or something that just, it's not dependent on a commodity price to do well. Exxon does have that flaw in the whole idea. So that is Exxon. Let me park it there. Looks like Paul is on the stream. And he asked me a question. What do I think of the healthcare space for next year? And I'm going to give you an answer to that, which is that I think the healthcare space is going to do well. Let me open up a screen. And I'm going to open up by industry on Stock Analysis. And FYI, I've been using Stock Analysis for a couple of years. I really like the site because it doesn't give me a bunch of like advertisements and stuff. I pay for their service, their access. Happy to, because I make a lot of money on my portfolio. I need the right tools, and the right tool for me is Stock Analysis. If you want to be a paid member or a subscriber to Stock Analysis, please use my code and I get credit for that. I'd appreciate that. I started using Stock Analysis before they sponsored me. And you could tell because it's been on my videos for 2 years, maybe 3. All right, so we're going to look at healthcare. So a couple of things that I'm going to point out is healthcare traditionally has been a stable industry. And the 5-year return in some sectors has been really, really good. Some industries, excuse me. But some, like pharmaceutical retailers, have lagged. Healthcare plans lagged. That's where United Healthcare is. And I think there's some opportunity. The short answer is I think healthcare is going to do well in 2025. And if you are a risk taker, you can go into some high growth biotech companies that are growing really well. I did a best and worst biotech companies video, and I released it in the last week. If you're an advanced member or higher, take a look. And I think I put out some good content there on ideas for biotech. And that's this here. Biotech is up the 1-year change, up 67%. It's up 93% as a whole, the whole industry. And it's the most valuable industry. Okay. I came out of that with a couple stocks that I think look really good. And other places are a good place. Here you can find some small caps that are really on the up and up, like Rigel. Looks good. So I think in general, healthcare is going to do well in 2026. And I've got a good portfolio of stocks in healthcare. So thanks for asking. All right. So looks like Bo is here. How you doing, Bo? Good to see you again. So how many shares do you need to see a nice payday? And I'm not sure which stock you're referring to. How many shares do you need? Can you give me a little more there, Bo? I want to answer your question. How many shares do you need to see a nice payday? And I'm not sure what I was talking about. All right. And then we got a request. Look at MDT. Glad to. So MDT. Benton. Oh, Exxon. Okay. So on Exxon, you know, Exxon's going to pay that dividend. They're going to pay this dividend guaranteed. And in a year, they're probably going to raise it. And it's going to be higher in 2 years. And it's going to be higher in 3 years. So if you're looking at, hey, I'd like to have $100,000 of Exxon, then you're going to be paid about $3,450 in that year. And each year that's going to increase 2 to 3%. So maybe in 5 years, you're making $4,000. In 10 years, you're making $5,000 in income, dividend money each year. And you're holding the Exxon stock. I like to play oil by buying when times are good to buy and then holding, because on average, it's going to go up and down. Warren Buffett owns oil. I like owning a couple oil stocks. I own Oxy. I own Chevron. And they pay that dividend. It's good, especially in down years like 2022. Exxon and company, they outperformed the market big time. See here, when all stocks were crashing, this stock went higher, much higher, outperformed the market. But ever since then, it's pretty much gone sideways. But you were paid that dividend. So back here, you're pretty much doubling, tripling your stock price, and you were being paid a dividend. Isn't that awesome? So that's why energy at times looks like a genius investment. This is where Warren Buffett was outperforming the market big time. And he had Oxy, he has Chevron, he has, I think those are the two energy stocks he owns. All right. So hopefully that answers your question, Bo. Thank you for the super chat. Yeah. Again, it just depends on what you're looking for. Some investors want, they want to fund a particular lifestyle, and the dividends would kind of provide the income that they want. You can aim for, I don't know, $50,000 a year in income. You could have that number, and dividend stocks could be in that strategy, along with maybe some corporate bonds. They could pay you 6%, and together those can, add up, and you got a nice portfolio that's generating $3,000, $4,000, $5,000 a month in dividend income. Now, I'm not like I buy dividend stocks and that's my main investment vehicle. No, I'd rather make 100% on a stock in 2-3 years versus waiting around for 3.45% dividend. But I want to cover dividend stocks because those are important to people. But my investing strategy is to outperform the market by seeing the stocks that I buy appreciate fast. That's my preference. Okay. So I'm still going to prefer, hey, I want to find the next Robinhood. I want to find the next Reddit. I want to find the next Astera Labs. I want to find the next Nvidia. They're out there. We got to find them. Find them, identify them, invest, feed winners, make lots of money. Thanks again, Bo. And it looks like Benton, you also want to look at BAX. Is that Baxter? Take a look at that. Let me get through a couple of these dividend stocks, and then we'll get to your list. Good stuff, guys. Looks like we have a second string of investors joining the chat. Awesome. Good to have you. Thanks for joining. Let's get into some dividend paying stocks. Now, Johnson & Johnson has a very strong reputation. This is like a solid company. They haven't been a super great investment up until late. And this stock flew up from 150 to 206. So the 1 month looks good. Year to date, very good. Excellent. 42%. And you're being paid that dividend. And Johnson & Johnson is a healthcare company. It's a well-diversified company, having products that end up in hospitals, pharmacies, all kinds of stuff. Very, very good company, very good credit rating. Big cap, 497 billion. So most definitely, if you use the rear view mirror, you're like, oh man, buying this stock a year ago was a really good move. Yeah. But I think this thing can keep working because you see that it wasn't doing much for 4 years. We look at it historically. Look at that monster. Hoo-hoo. So this monster, I would wait for it to kind of settle down a little bit. It looks like it's gone up a little too fast, too quick. But let's keep going. I think I have a valuation on Johnson & Johnson I'll share with you. So this stock's really, really done well. That dividend is still at 2.5, and analysts do think it's getting a little expensive. When we look at their forecast, this is what analysts are thinking. How's the company going to grow? It's growing at 6.6%. That's pretty decent for a very big company, almost $100 billion in revenue. And they're going to grow by 5% next year, the year after 5, and then 5. So real consistent. And profits are going to expand. So this company is going to operate in mid-teens, higher teens of a PE ratio. Again, it has a strong reputation. Kind of older investors are really going to identify and appreciate a company like Johnson & Johnson. Now, I have a valuation for this company, and I included J&J in a best and worst healthcare stock to invest in. It's a couple months old, but it's on my channel if you want to take a look. I'm agreeing with the analysts that think it's a little overpriced. I agree. It's a little overpriced. So that's where I'm at with J&J. I think, if an investor really wanted J&J for the dividend, I think you're paying too much right now. I'd probably wait for it to settle down, and then I'd jump into the stock. So that's where I'm at. I think the growth was a little better. I'm going to go with 5% growth there. Okay. All right, Bo. So which would I prefer? Well, sorry. Oxy or Exxon? Occidental. So we looked at Exxon. Now, why do I prefer Occidental? What I did is I looked at the 5-year average of what they did for cash flow, just so I could smooth out some of the peaks and valleys of the commodity market. And just in general, Oxy tends to be a performing stock. I also went with a very high discount rate. So if we have any kind of move on oil, this stock's going to double in price. So that's the lane that I prefer versus Exxon. So if you're going to ask me Exxon versus Oxy, I'll take Oxy. I'd rather have Occidental. I think Exxon is a good stock. I know some other investors that are part of this channel like Exxon. I can't argue with them. But when you go Oxy, you get a dividend, not as high as Exxon, but you could see today this thing had a pretty nice little move. Hasn't been doing much for the 1 year. Year to date sold off. So this one's going to be more volatile. But man, when it works, it works. It goes up fast. This one here outperformed most of the bigger energy companies, going from 17 all the way up to 73 very quickly. I think we're setting up for any kind of move on oil. Like if oil goes to 65, Occidental is going to fly up. So Occidental would be my choice. It's an investment that I've already made. I like Occidental, very well run company, and it's a higher risk, but big reward. I would sell my Oxy shares if we saw a big run up on oil. I would get out, and then I would wait for oil to come down, and then I'd do it all over again. So Oxy is my choice. So what's going on with Uber? Yeah, so I covered that early in the stream, but let me recap for you. So we researched and didn't find that Uber there was something big going on. I think there was some kind of analyst had a so regulatory headwinds for Uber and a Stanley analyst downgraded the stock. At the same time, like Ackman is in the stock. They're doing more things with vendors on Shopify to do 1 hour delivery. So that looks really good. Overall, I think this was overdone and I bought shares today. I think it's a really good company going higher over time. And when I value the stock, I have Uber nicely discounted. So I didn't see anything like structurally. It's just the rumor that, hey, Europe is going to charge them some fees because it's so darn big. Well, welcome to Europe. I think Meta gets charged fees. Google gets charged fees. They call them penalties, but they're like, hey, you're so big, we're going to give you penalties. But Uber is just a fantastic opportunity. I think it's going to go higher over time. They've become structurally really big. Their network power is immense. Their ability to generate cash is awesome. So all those things I love about Uber, and that's why I bought shares today. And tomorrow, if it's priced around the same level or discounted even more, I'll buy more shares. I'm good buying shares of Uber all day long. It's the fifth biggest position in my portfolio, and I'm okay being concentrated in great companies, and Uber is one of those great companies that I have about 5% of my portfolio in. So that's a quick recap, Bo. Thanks for asking. Thanks again for the super chats. And I got your message there, Benton. Thank you, sir. All right, before we jump into dividend stocks, let's go over MDT. Kind of knock that one out. And MDT, Medtronic. So Medtronic develops, manufactures, and sells device-based medical therapies to healthcare systems, physicians, clinicians, patients in the US, Ireland, internationally. So Med Devices. So big company, 95,000 employees. Year to date, up 26%. 1 year, 20. And you see that this stock really sold off after COVID. 2021, it started this big sell-off. But the 1 year looks good. Year to date looks decent. And you have this dividend that's being paid. Market cap of $129 billion, revenues of $34 billion. Analysts think there's still a little discount left. And looking at their revenue growth, they closed their books on the fiscal year 2025 on April. They grew by 3.6%. The quarterly looks like the growth is accelerating. That's probably why the stock's been working nicely this year, is this revenue has really impressed investors, showing that, hey, they're getting bigger quickly. Now looking at the trailing 12 months to see, is this a really desirable company, right? We've seen what great looks like. Free cash flow is steadily growing, but not leaping forward. It's just growing a little bit. Gross margins are good, 65%, knocking on the door of great, but good for now. Profit margins, okay, knocking on the door of good. Free cash flows, good. Could be better, but 15% is not bad. So these are solid numbers. These numbers, and I think Medtronic is a stock that I valued. Before I go there, let's look at the forecast, and then I'll get to my valuation. So these guys are supposed to keep growing. Nice, consistent growth. This is what I like about healthcare, is you just see this consistent growth because people need, in this case, the med devices that Medtronic produces, and their profits are going to expand, bringing down their PE ratio to a really nice low level. So that's a good opportunity. This would be a nice dividend stock to really throw into the mix, because I think it's a solid business. it pays a nice dividend and stands to continue to appreciate higher. Now, when I look at Medtronic, I think I have a valuation. Let's take a look at. I don't, so I'll have to create that. Let's go with. I think the stock that I. So I'm going to park it right here. Here's another. So ResMed is a med device company. It's not as big as Medtronic, but it's a med device company. So let's create a valuation for Medtronic. Bang that out. See where it is valued. All right, so I'm going to refer to the data on another screen you guys can't see, just so I can look at one screen and then update the valuation model that I have open. And so the trailing 12 months free cash flow is $5,206,000,000. What was the growth rate that they were experiencing? It was like 6 or 7. So I'm going to go with 6% growth rate. I'm going to go with 7. So their profitability is expanding a little better. Okay. So that gives me an intrinsic value on the cash flows that I expect in the future, collectively, all future years, $161 billion. So now I want to add cash and take away debt. Let's do that. So we have $8,330,000,000. We have debt of $29,100,000,000. So the stock is priced with an 8% discount if I look at the value of the cash flows and compare it to the current stock price. So not a giant discount, but a decent discount, and its healthcare should be consistent. It should be a rising stock because healthcare is a necessity, whether we're in an economy that is booming or we're in a recession. People will get their healthcare. You can't postpone a surgery that's going to save your life or really change your standard or your quality of life, I should say. All right, so the year that I want to look at for the earnings per share is what they call their fiscal year 2026. That's $5.70. P ratio, I'm going to go with 18. And the growth rate, we'll leave it at 7. So look at that, an 8. So perfectly an 8. So you have an 8% discount on Medtronic. It's a low risk and reasonable reward stock. And depending on what you're looking for, if you're looking for a dividend payer, you got it. If you're looking for something that should rise over time, you got it. But it's not going to be a stock that I think you look back after owning it for 3 to 5 years, you look back and you're like, cool, I doubled my investment. I don't think that's going to be the case. I think if you were to get, a couple of years down the road and you're up 25 to 40%, that'd be a win along with that dividend. That would be a win with a Medtronic because it's a stable business. It's an adequate grower, but it's not going to boom. It's not going to be doubling in its stock price very quickly. So that's what you're looking at with Medtronic. Appreciate you asking, Benton. Hopefully you found the analysis interesting. And I will add this to my watch list just to make myself a note that I want to add this guy. And I'll fill in the blanks later. And I keep track of all the valuations I create, and then I give access to advanced members. So if you're interested in having access to my repository, become a member, and then you'll be able to access this 24/7. I just updated the repository this past weekend, so only a couple of days have gone by since I last updated it. And I think there's over 600 valuations in there. So you can take a look at my research that I've really completed over the last couple of years on it. So that's Medtronic. Thanks for asking on that, Benton. Appreciate it. Thanks for tuning in tonight. Great to see you, Bo. All right. So, yeah, Benton. Thanks for tuning in. Thanks for the question on Medtronic. So we are an hour and 46 minutes into the stream. Let's knock out a few more of these stocks that are dividend payers. All right, so we went over Medtronic. It's not a bad idea for a dividend stock. Bank of America. Bank of America pays a 2% dividend, and it had been doing really well. I think it kind of gave up some. It's still doing well. Up 17% year to date, up 23%. The 5-year, if you bought Bank of America at the right times, you are sitting pretty. You could have bought this, stock at $25, $27 a share and doubled your money. Again, when we buy a stock is really important, because if you saw this, if you bought into banks, which I did with Citigroup, you're sitting pretty. You made all your money. You doubled the capital. If you put in 10 grand, you have 20 grand now, and you're getting paid an income. And you're getting paid an income. And if you do the math and you bought at half its current stock price, it's really like being paid 4% dividend, because you only paid $25 a share. So it's a terrific stock if you find the right times to buy it. It is a good quality bank. We all know what Bank of America does, big giant bank, and they've been performing quite well. The future looks pretty good. This stock was up 1%. Overall, market cap 394. Might be the second biggest bank. I think JP Morgan's number one. These guys are number two. Warren Buffett invested in these guys, and of course, he made a killing on the darn stock. And now he's selling some of his shares, but I'm sure they're just trying to rotate and diversify, buy some more Google shares, because that's one of their big investments now. So Bank of America is solid. Let's take a look at the forecast. Analysts think, hey, you're getting a little discount, because just everybody knows Bank of America, held by many, many ETFs and many investors. These guys are going to grow their profits nicely, get their PE ratio down to single digits by 2028. And I did a lot of homework on banks. In fact, I put together a nice little schedule. I'm an investor in Citigroup. And what I did is I put the big banks on a schedule here, from ranking them from what I thought was most desirable to least desirable. And I created this here. Citi has the best price to book. Bank of America is pretty good. And you want to look at price to book when it comes to banks, because the book value of the assets, they own debt, like individuals owe them money for a mortgage. Corporate clients owe them money because they lent out on a project, or maybe they lent out some working capital to a business. So their book value is all those assets they carry on the balance sheet compared to their stock price. If you're near 1-to-1, you're basically buying a bank where the assets are worth the stock price. The higher you go, like JP Morgan, the balance sheet is nowhere near the value of the stock. The stock is only worth maybe a third of the assets on the balance sheet. So we want this number to be as low as possible. Citi has the best ratio. Bank of America is pretty good. P ratio is nice and low, and so is Citigroup. So it ranks very high in my rankings, and I'm good with Bank of America. It's a solid investment. I could see why they put it on the list of some of the better dividend stocks. So that is Bank of America, and it had a good day. I'm curious to see, what did Citigroup do? Here's Citigroup. Citigroup went up nice. Year to date, up 57%. See those ratios, the homework, right? You do your homework and you find the money. You find the money. You say, hey, this ratio, when I started buying into it, price to book was like 0.8. And investors will sniff out where they have good value. So I'm sitting pretty. Made a lot of money on the appreciation, and they pay me an income. Nothing wrong with that. So I like Citi. I think this one's going to double my capital. And some of the best days are behind it, I have to admit. But hey, I'm glad that I bought the stock, invested in it. And I switched horses. I used to own JP Morgan, made money on it, sold it because it got expensive. I think I showed you that JP Morgan was getting expensive. The price to book showed that, hey, out of the big banks, they're the most expensive one. P ratio, not too high, but again, the price to book is an important factor. So I sold JP Morgan and switched horses over to this one. So far, excellent. Really glad that I did so. And that is Citigroup. My valuation is good on Citigroup, and I'm going to keep holding those shares. All right. So let's keep rolling. So we went over Bank of America. So United Healthcare, I would have thought we'd be further along on the recovery of United Healthcare, but it's just been kind of just slowly grinding higher. It had a good day today, but overall, I think this is going to do well in 2026. The big sell-off, this is what I want you to keep in mind, is this stock was just humming along. CEO got assassinated, super negative story. And then the stocks really plummeted with just a lot of negative stories surrounded United Healthcare. And meanwhile, this stock just kept growing revenues. This is a big company, continues to grow. Look at the growth in the last 2 quarters, 12%. And they're trying to figure out how they're going to subsidize healthcare for people in the United States. And I think the way that they're working it out, it's going to benefit United Healthcare and other big health insurance companies. So this thing is set to just go back to where it used to be. And if that's the case, it's going to go back to $600 a share. And my shares are going to go up and double. I've owned United Healthcare before. It's been a fantastic stock for a long time. So I made money on them. I sold United Healthcare. Now I'm back. Nothing wrong with making money on a stock on 2 occasions. And United Health is a stock that I'm back into. And I think it's going to go well. It's taken a little bit of time, but if they sort that whole bill to fund healthcare and give a subsidy to people that are maybe lower income that want to have health insurance, this guy's going to really work. And I'm really glad that I own it. Historically, United Healthcare did not need to pay a dividend. They used to pay like a 1% dividend, but the stock has gone down so much that right now you can earn a 2.69% dividend, which is quite attractive. So this stock can reward an investor. And this is probably going to be up toward the top of the list of a stock that can win in 2 ways for an investor: appreciate and pay a dividend. This one I like. This one I like a lot more than Exxon. I like it more than J&J. I like it more than Citi. I like United Health. I think it has great potential. Let's see how it goes over the next 6 months, hopefully a year from now, it'll be a nice big winner. It'll be trading at $500 a share. We shall see. We shall see. Morgan Stanley. These guys, I did put him in a best and worst financials stock video that I created, and they were okay. Now I'm not convinced. I think it's an okay stock. It went up a little bit today. It's going up in after hours, and their dividend is 2.23. The 1 year up 39%. It's gone up really nicely now. I can't invest by just looking at the rearview mirror. It's not like they're going to repeat this. Of course, the market's been booming for stocks, and these guys, they do well when the stock market does well. I think the stock market's going to be fine next year, but these guys, their stock price maybe got a little too expensive. This one I would be a little careful with. Merck, this one I looked at yesterday or maybe this morning on the stream, and I came up empty. This one's just, it's a little bit of not in good shape. And did I do a valuation on this guy? Let's take a look. No, I didn't. But the conclusion was that it's just not good enough. There's other alternatives. So this one is probably going to be ranked toward the bottom, but a good example of what I'm trying to avoid. They just don't create enough profit, cash flow, and they don't have any momentum. Their business isn't growing very well. You see their cash flow has been deteriorating, not increasing, decreasing. That's not good. That's bad. And I think there's alternatives out there in the same industry that I think look better than this. So I'd rather go with those. For now, these guys got to prove they can grow. I think the forecast was for a little bit of growth. Growth looks pretty good. It's just hard to get to their valuation. With their current free cash flow, I think I got up to maybe 150 billion in value because they do carry some debt. Once I decrement that debt, it brings it down. So it's just not a really attractive opportunity for me. So Merck would be a pass. All right, guys. So good to see a lot of you guys, a lot of the regulars. Thanks, guys. Wanted to stream tonight. I'm going to stream tomorrow night. So this is the last call, guys. Last call on stocks if you want me to look at them. And I'm gonna shut the stream down after I give you guys a minute to think about it. Willing to review some stocks for members, or if you want to buy a $5 super chat, I will review a couple more stocks. If not, let me just tell you about the member program. It's a good one. Take a look at it on my home screen. See if it's a good fit for you. It'd be great to have you as a member. And if you become an advanced member, you get access to Discord. You get access to member calls, as well as most videos I produce to this level. The stock portfolio buys and sells and overall conviction videos go to super investors. If you're a platinum investor, you get everything on this page. If you just want to come to live streams and put a symbol or a stock logo for me to review, become a value investor. It'd be great to have you. All right. So didn't see any new stocks, but I did get a lot of good comments out there. Good to see you, Matthew, Michael Anthony. Great to see you, man. Benton, thanks for all the good questions. Bo, great to see you stream after stream. Great to see you. And looks like Benton. Paul, great to see you. Thanks for showing up. Appreciate it. Looks like Muhammad. Thanks for tuning in. Thanks for saying hello. Anderson, great to see you. Glad to see you're a regular. Please come back. And Herdo, thank you so much for the super chat. That's awesome. Thank you so much. Michael Anthony, again. Tony, good to see you. And Lendelos, very good to see you. Thanks for the question. Thank you so much for the super chat, Adam Skidmore. And thanks for coming back. You're becoming a regular. Really appreciate it. Thank you, sir. And I think that's it, guys. So that is it for tonight. Thank you so much. Appreciate it. Fingers crossed that we trade higher tomorrow. We have a little bit of a mixed market, and I think it's might be a flat day tomorrow. We'll see what Friday does. If we have good earnings tomorrow by those two big giant companies, maybe that causes a rally for Friday. Fingers crossed. So have a good night. Good luck with your investments. Good luck with your trades. Please come back. I'm going to stream tomorrow, same time, 7 p.m. Eastern. Stream for a couple hours. Bring the stocks you want me to look at. And then I'm going to stream again with Daryl on Friday morning at 9 a.m. Eastern. So pick whichever time works for you or come to both. Nothing wrong with that. It'd be great to have you on both streams. So thanks, everyone. Have a good night.